Stop right there. Before you touch a single dollar from your retirement account this year, you need to hear what I'm about to tell you. Because right now, 84% of retirees are making a required minimum distribution mistake that is quietly costing them thousands of dollars, sometimes tens of thousands, in unnecessary taxes and IRS penalties. And the worst part? Most of them have no idea it is happening until it is too late. This video could save you a serious amount of money, so stay with me all the way through. If you are 73 years old or older, or if you are getting close to that age, this is one of the most important financial topics you will ever deal with in retirement. We are talking about required minimum distributions and their RMDs, and the IRS takes them very, very seriously. They do not send you a friendly reminder letter. They do not give you a grace period. They expect you to know the rules, and if you get it wrong, you could be hit with a penalty of up to 25% on whatever amount you missed taking out. That is money gone, forever, right out of your retirement savings. And with new rule changes that have come in over the last couple of years, the old way of thinking about RMDs could now be costing you even more than it used to. I know this can feel overwhelming. Numbers, tax rules, IRS deadlines, it is a lot. But I promise you, we are going to walk through everything together, step by step, in plain, simple English. Because you worked your whole life to build that nest egg, and you deserve to keep as much of it as possible. Let us start from the beginning, because some of you may be hearing this term for the first time, or maybe you just need a refresher. A required minimum distribution is simply the minimum amount of money the federal government requires you to withdraw from certain retirement accounts each year once you reach a specific age. We are talking about traditional IRAs, 401ks, 403bs, and most other tax-deferred retirement accounts. Here is why the government requires this. When you put money into a traditional IRA or 401k, you got a tax break up front. You did not pay income taxes on that money when you earned it. So the IRS has been waiting very patiently for their share. Once you hit the required age, they say, okay, now it is time to start pulling that money out so we can tax it. That is all an RMD really is. It is the government's way of collecting the taxes they have been deferring for years or decades. Now here's the part most people miss. The age at which RMDs kick in has changed. For years it was 70 and a half, then it changed to 72. And now, thanks to the Secure 2.0 Act that was signed into law, if you were born in 1951 or later, your RMD starting age is now 73. And if you were born in 1960 or later, it will eventually be age 75. This is a big deal, and a lot of retirees have not updated their thinking to match the new rules. Pay close attention to this because here are the 7 most common RMD mistakes that retirees make. And any one of these could trigger a penalty or a bigger tax bill than you ever expected. Mistake number 1, not taking your RMD at all. It sounds obvious, but you would be surprised how many people simply forget, especially in that very first year. If you miss your RMD deadline, the IRS can charge you a penalty of up to 25% on the amount you should have taken out but did not. That has actually been reduced from the old 50% penalty thanks to Secure 2.0, but 25% is still a massive hit. On a $20,000 distribution, that is a $5,000 penalty, just gone. Mistake number 2, taking the wrong amount. Your RMD is not a fixed number. It changes every single year based on your account balance and your age. Many retirees just repeat the same dollar amount they took last year without recalculating. That means they are likely taking too little, which puts them out of compliance with the IRS. Mistake number 3, thinking your Roth IRA has an RMD. Good news here, it does not. Original Roth IRAs are not subject to RMDs during the account owner's lifetime. However, and this is important, inherited Roth IRAs do have distribution requirements. So if you inherited a Roth from a parent or spouse, you need to check the rules carefully. Mistake number 4, forgetting about multiple accounts. If you have more than one traditional IRA, you can actually add up all the RMDs from those accounts and take the total from just one of them. But if you have multiple 401ks from different employers, you cannot do that. Each one has to be satisfied separately. A lot of people do not know this distinction, and it can cause real problems. Mistake number 5, not understanding the first-year rule. In your very first RMD year, you are allowed to delay taking that distribution all the way until April 1st of the following year. Sounds like a nice option, right? But here is the catch. If you do that, you will end up taking 2 RMDs in the same calendar year, which could push you into a much higher tax bracket and trigger bigger taxes on your Social Security benefits and Medicare premiums. For many people, it is actually smarter to take that first distribution on time in the year it is due rather than delay it. Mistake number 6, using the wrong life expectancy table. The IRS updated its life expectancy tables a few years ago, and many retirees, or even their financial advisors, are still calculating RMDs using the old tables. The new tables generally allow for slightly smaller distributions, which means a lower tax bill for you. But if your advisor is using outdated numbers, you could be over-withdrawing unnecessarily. Mistake number 7, not planning for the tax impact. This is probably the biggest one of all. Your RMD counts as ordinary income. That means it gets added to your Social Security benefits, your pension, any other income you have, and it could push you into a higher tax bracket, cause more of your Social Security to become taxable, or even trigger higher Medicare Part B and Part D premiums, which are based on your income from 2 years prior. This is called RMD, the income-related monthly adjustment amount, and it catches a lot of retirees completely off guard. This is where it gets serious, so I want you to know whether this applies to you specifically. If you are 73 or older and you have a traditional IRA, 401k, 403b, CP IRA, or simple IRA, you are required to take RMDs. Period. There is no way around it. If you are still working at 73 and you have a 401k with your current employer, there is actually a special rule that may allow you to delay RMDs from that specific account until you retire. But this does not apply to IRAs or to old 401ks from previous employers. If you are a surviving spouse who inherited a retirement account, the rules are different for you than for other beneficiaries. You may have the option to roll the account into your own IRA and delay RMDs based on your own age. But you must handle this correctly or you could face unexpected penalties. If you are a non-spouse who inherited an IRA after 2019, the old stretch IRA rules no longer apply to you. You are now generally required to fully empty that inherited account within 10 years. And in recent guidance, the IRS has clarified that in most cases, you actually need to take annual distributions during those 10 years, not just drain the account at the end. This has caught a lot of people completely off guard. And if you are a public employee with a pension, a teacher, a firefighter, a government worker, your pension income is separate from your IRA. But if you also have a 403b or a deferred compensation plan from your employer, those accounts may also be subject to RMD rules. Do not assume your retirement accounts are automatically handled by your employer. Meet Dorothy. She is 74 years old, lives in Ohio, and has a traditional IRA worth about $450,000. She has been collecting Social Security for a few years and also receives a small pension from her former employer. Dorothy dutifully takes her RMD every year. She is proud of that. But here is what Dorothy did not realize. Because her RMD pushed her income over a certain threshold, 85% of her Social Security benefits became taxable, instead of the 50% she had been paying taxes on the year before. That one change added nearly $1,800 in additional taxes she was not expecting. And on top of that, her Medicare Part B premium went up by $69 a month the following year because her income crossed an IRMA bracket. Over a full year, that is an extra $828 out of her pocket, just in Medicare premiums alone. All from one RMD she did not plan carefully enough. Example 2. The inherited IRA mistake. Now meet Robert. He is 67 years old, and his mother passed away in 2021, leaving him her traditional IRA worth $180,000. Robert knew he had 10 years to empty the account, so he figured he would just wait and take it all out at the end when he was 77. What he did not know was that under recent IRS guidance, because his mother had already started taking her own RMDs before she passed, Robert was required to take annual distributions during that 10-year window. He could not just wait until year 10. He missed 3 years of required distributions before a tax professional caught the error. He had to file amended returns, pay back taxes, and request IRS penalty relief. It was stressful, time-consuming, and cost him thousands of dollars in professional fees, all because of a rule he simply was not aware of. Now here is the part most people miss. And this is where the real danger lives. The IRS does not automatically send you a bill or a notice when you forget or miscalculate your RMD. You will not get a phone call. There is no automatic alert. You simply file your taxes the following April, and if you did not report your RMD correctly, you could get hit with a penalty notice months later, sometimes more than a year after the fact. By then, there is interest on top of the penalty. And the stress of dealing with the IRS is something nobody needs in retirement, and it goes beyond just the penalty. If your RMDs are pushing your income higher than it needs to be, you could be losing hundreds of dollars every month in Medicare premium surcharges. Over a 10 or 15-year retirement, that adds up to a staggering amount of money. We are not talking about pocket change here. We are talking about real money that should be in your pocket, not going back to the government. The saddest situations I hear about are retirees who did everything right their whole lives, saved diligently, invested wisely, sacrificed for decades, only to lose a meaningful chunk of their nest egg in retirement because of rules they simply were not taught. You do not have to be in that group. The information you need is out there, and this video is a great first step. All right, let us talk about what you can actually do. Here are your clear, simple action steps. Step 1. Find out your exact RMD amount for this year. Do not guess. Contact your IRA custodian. That is the bank, brokerage, or financial institution that holds your retirement account, and ask them what your RMD is for the current year. Most major institutions like Fidelity, Vanguard, Schwab, and others will calculate it for you. You can also use the IRS Uniform Lifetime Table and your account balance from December 31st of last year to calculate it yourself, but calling your custodian is the easiest place to start. Step 2. Check your deadlines. Your annual RMD deadline is December 31st. The only exception is your very first RMD, which can be delayed to April 1st of the following year. But as I mentioned earlier, think carefully before doing that because of the double distribution tax impact. Step 3. Look at your full income picture before you take your distribution. Before you pull the money out, sit down and add up all your income sources for the year: Social Security, pension, part-time work, interest, dividends, and what your RMD will be. Then look at where that total falls in relation to IRS tax brackets and IRMA thresholds. You may be able to take your RMD earlier in the year, or later, or in a specific amount that keeps you under a critical income line. Step 4. Consider a qualified charitable distribution if you are charitably inclined. If you are 70 and a half or older, not 73, this rule starts earlier, you can donate up to $105,000 per year directly from your IRA to a qualified charity. This is called a QCD, and it is a powerful strategy because the amount you donate counts toward your RMD but does not get added to your taxable income. If you give to your church, a food bank, a hospital, or any other qualified charity, this could save you a significant amount in taxes. Step 5. Talk to a tax professional or a fee-only financial planner. I know not everyone has access to a financial advisor, but this is one of those areas where even a single one-hour consultation could save you thousands of dollars. Look for a certified financial planner or a CPA who specializes in retirement income. Ask them specifically about RMD planning, Roth conversion strategies, and IRMA management. It is worth every penny. Step 6. If you have already made a mistake, do not panic. The IRS actually has a process for requesting penalty relief, especially if the error was reasonable and you correct it quickly. File IRS Form 5329 with your return and attach a letter explaining what happened and what you did to correct it. The IRS has waived penalties in many cases, but you have to ask. Here is what I want you to walk away with today. You are not alone in finding this confusing. The rules around RMDs have changed multiple times in just the last few years, and even financial professionals sometimes get them wrong. The fact that you are here, watching this video, asking questions, trying to understand, that already puts you ahead of the 84% who are not paying attention. You spent your whole working life doing the right thing. You saved, you sacrificed, you planned for this season of life. You deserve to enjoy every dollar of it, and with just a little knowledge and a little planning, you can avoid the traps that are costing so many retirees their hard-earned money. So please, do not let another day go by without knowing your RMD number for this year. Do not leave that to chance. Pick up the phone, call your financial institution, or sit down with a tax advisor. Your future self will thank you. If this video helped you today, please give it a thumbs up right now. It truly helps more people like you find this information when they need it most. And if you are not subscribed yet, hit that subscribe button and ring the bell so you never miss an update that could affect your retirement income. We cover Social Security, Medicare, IRS rules, and everything that matters to you and your money every single week. And please, share this video with a friend, a sibling, a neighbor, anyone you know who is in or near retirement. You might just save them thousands of dollars. That is a gift that money cannot buy. I will see you in the next one. Take care of yourself and take care of that nest egg. You earned it.